A very good morning, children. Now we are starting with the methods of calculating national income. Okay. Now coming to national income. We finished with national income and related aggregates. Now we are supposed to do the methods of calculating national income. Now we have studied in the first two chapters of macroeconomics that there is circular model, and it is called also called the triple identity. You have the producer sector and the household sector. Okay, so when the household sector is spending, and then the producer sector is going to get the factor services from the household sector, and from the producer sector there would be factor payments, and they're also going to supply the goods and services. Okay, so it's a two sector economy. So based on this particular model, children, now there are three methods which can be estimated for calculating national income. Now, as the sum total value of value addition in the economy, which is called the value added method, the first method of calculating national income, as the sum total of income generated in the economy, which is called the income method, the second method of calculating national income, and then as the sum total of expenditure on final goods and services produced in the economy, called as expenditure method, the third method of calculating national income. So first we are going to study value added method. Okay, now value added method, children, we know what is value added. If you add something extra to your production process, then that is value added. Okay, something like I also explain you what is VAT, value added tax. The same way you have value added method. Now it measures the national income in terms of value addition by each producing enterprise in the economy. What each producing enterprise is adding value to the economy, that is being measured by the value added method. It is also known as industrial origin method and net output method. Another name for value added method is industrial origin and net output method. Then estimation of contribution to all the producing enterprises to production in domestic territory of the country during the year is equal to the market value of GDP, called GDP at market price. It is adjusted to find out NNPFC, that is net national product at factor cost. Nothing but this third point is actually trying to tell you that all the producing enterprises in the economy, what are they going to produce within the domestic territory of a country? Whatever they produce, the value of those goods and services, it is called gross domestic product and GDP at MP. Why is it called GDP at market price, children? Because we still have to pay taxes to the government, right? So that is the reason that it is called GDP at MP, and it is adjusted. Okay, GDP at MP is adjusted to find out the national income. NNPFC is nothing but national income. I told you in the previous sessions also that national income is calculated at factor cost, also called as net national product at factor cost. Okay, now value added, in this particular method we have some formulas. So what is value added? It is nothing but value of output minus intermediate consumption. Now intermediate consumption is nothing but the raw materials, children. Value of output, that means the total value of the product minus the raw materials. We will come to know how much value we have added to the product. Okay, so value added is value of output minus intermediate consumption. Now, what is value of output? It's nothing but the sales. If the entire output is sold, if you are in a position to sell the entire output, what you have produced, then value of output is nothing but the sales. But just in case if the stock remains, then value of output is sales plus, remember we use this as change, that is change in stock if some output remains unsold. So value of output will be sales plus change in stock if you are not in a position to sell whatever you have produced. And how do we calculate change in stock? Closing stock minus opening stock. Okay, so these are little formulas which we having which is there in this particular value added method. Okay, Now, as I told you, children, whatever the producing enterprises are going to add to the economy, that is called as gross domestic product. Now, as this particular example is from your textbook only, now estimating value added, you see these are all the producing enterprises: the farmer, the flour mill, the baker, and the shopkeeper. Okay, and this is the value of output. That means whatever they have produced, the farmer, for example, if they have produced wheat will get converted into a flour, then the baker is going to take it to make something, and then, for example, the baker is taking to make bread, and the shopkeeper is going to sell the bread in the market. Now this is the value of output, 600, 800, 1000, 1200. And the cost of intermediate goods, so this is 200, 600, 800, 1000. This is the value of their raw materials which they have used. So if you subtract value of output, okay, cost of intermediate goods, then you're going to get value added. That means 600 minus 200, you will get 400. That means the farmer has added 400. And then flour mill, 800 minus 600, 200 was the value added by the flour mill. Then 1000 minus 800, 200 was added by the baker. 1200 minus 1000, 200 was added again by the shopkeeper. So the value which is being added by all the enterprises is 1000. So 1000 is nothing but your GDP at MP, that is gross domestic product at market price. Okay. Now, GDP at MP, we know that gross is inclusive of depreciation. So when you subtract depreciation, it's going to become net. So gross domestic product at market price minus depreciation, you will get net domestic product at market price. Okay, very important formulas, children. Then net domestic product at market price. If you subtract net indirect taxes, you will get net domestic product at factor cost. Remember, we discussed about taxes and subsidies. The taxes is going to increase the cost and subsidies is going to decrease the cost. So if you adjust indirect taxes and subsidies, you will get net indirect taxes. Okay. So if you subtract net indirect taxes from NDP at MP, then you will get NDP at FC. Then net domestic product at factor cost plus net factor income from abroad, NFIA. If you add the national income from abroad to the domestic income of national, then you will get net national product at factor cost, which is nothing but national income of our country. Okay, this is how it is adjusted. The value added method is adjusted to get the national income. Please remember these formulas and practice this. Okay. Now, there are some precautions to be taken while we calculate the value added method. Very important points to be noted. Precautions in calculating national income by value added method. Avoid double counting. We all know what is double counting. If you count raw materials price and also the value of the product, then that is nothing but double counting we are doing. That is the reason we straight away take the value of the product in the national income. So avoid double counting. So value of intermediate goods, it's not included in the estimation of value added because value of intermediate goods is reflected in the value of final goods. So avoid double counting of goods and services as these tend to inflate national income estimates. See here, in this particular example, we are subtracting the cost of intermediate consumption, that is the value of raw materials is been subtracted, right? So the same way, we are not going to add the value of intermediate goods, that is raw materials. Fine. So avoid double counting. Fine. Then the next is do not include the sale of second-hand goods. We do not include the sale of second-hand goods because first time when it was purchased, it was already added in national income. Value of second-hand goods or used goods being sold should not be included in national income as their value was accounted for the first time at the first time of first production. So sale of second-hand goods, it's not a production activity. The second-hand goods should not be treated as fresh production and therefore is not included in national income. The second-hand goods are not included. The value of second-hand good is not included. But however, any brokerage or commission paid to facilitate the sale of second-hand goods is a fresh production activity. It should be included in the production, but to the extent of brokerage or commission only. If any broker is selling the second-hand goods, then that particular commission which that person earns is included in national income, because he is selling that second-hand good to someone else for the first time. So the value of second-hand goods is not included, but the commission which the person earns on the sale of second-hand goods, that is included in the national income. Okay. Then self-consumed output must be included. Output produced but retained for self-consumption rather than selling in market is output and must be included in estimates. Like services of owner-occupied buildings, farmer consuming its own produce, etc. are some examples. So self-consumed output must be included. Like if at all there is, services, for example, if there is any building, okay, and the owner is only occupying that, then that is included. If a farmer is using its own produce, that is included in national income. So self-consumed output is included in national income. The same examples are repeated. On account of production of goods of the producing units, it's counted on account. So the same example which is given in point 3, children, car used by the car producers. If there is a car producer and if he's using his own car, then that is of course included in national income. Imputed rent on the owner occupied house is counted. Same way as I told you, services of owner occupied buildings. If a owner is occupying his own building, then that also is included in the national income, because every building has some value and the rent has to be included in national income. Then services for self-consumption is not counted. Example, the services of housewives. Okay, so any service which is for self-consumption, that does not form a part of national income, naturally, because we work so much that they cannot have the value of our services in the monetary terms. So it is housewife, children. I just wrote the spelling wrong, so just take care of this. Okay, now there are some key terms which I have mentioned here: the value of output, the double counting, value addition. Please go through some key terms which are very important. Okay, so this is all about value added method, children. Please go through the value added method very carefully from the textbook and also from this PPT. I shall also record the value, I shall also record the video of the problems and send it to you. Okay, please go through the explanation first and then look at the problems. Thank you.